Hey everyone, and welcome. So, you want to invest in the biggest and best companies in the US economy? You've probably heard about the S&P 500. But wow, there are a lot of options out there, and picking the right one can feel a little overwhelming. Today, we're stepping into the ring for an S&P 500 ETF Showdown to help you find the absolute perfect fund for your goals. All right, let's get right to the big question. VOO, IVV, SPY? There are a few other players in the game too, and they're all fighting for a spot in your portfolio. Now, on the surface, they might look almost identical, but trust me, there are tiny little differences in cost and structure that can make a huge impact on your money over the long haul. So let's dive in and figure out which one is the right choice for you. Okay, here's our game plan for today. First up, we'll do a quick refresher on what the S&P 500 actually is. Then, we're going to put the top contenders head-to-head. We've got the low-cost twins, the trader's choice, the new ultra-low-cost champ, and even a wild card, the equal-weight alternative. And then, at the very end, we'll figure out your perfect match. So, what is this prize that it seems like every single investor wants a piece of? Well, the S&P 500 is way more than just a number you see scrolling at the bottom of the news. It's basically a single investment that gives you ownership in the 500 most powerful companies in America. Here's the core idea. An S&P 500 fund just buys and holds stock in these 500 giants. But the key phrase here is market size weighting. What that really means is the biggest companies, the Apples, the Microsofts, the Nvidias of the world, have the most influence on the fund's performance. So when they have a great day, the whole index gets a really nice boost. And just look at the diversification you get. You're not just putting all your eggs in the tech basket, even though that's a pretty big slice. No, you're getting exposure to every major part of the U.S. economy, from healthcare to financials to industrials. It's like buying a snapshot of the entire economy in one simple investment. And that economic engine has been running hot. Over the last decade, the S&P 500 has delivered an absolutely incredible 15.6% average return every single year. I mean, that is well above its long-term historical average, which is closer to about 10%. All right, time for our first round. We're starting with two absolute heavyweights, Vanguard's VOO and BlackRock's iShares IVV. The best way to think about these two? They're basically identical twins, both battling it out to be the best set-it-and-forget-it fund for your portfolio. And when I say identical, I am not kidding. They hold the exact same stocks, they have pretty much the same returns, and this is the most important part, they share the same rock-bottom expense ratio of just 0.03%. They're both massive, high-quality funds, and honestly, they're perfect for long-term investors. Expense ratio can sound a little abstract, so let's make it real. That 0.03% fee, what it means is that if you invest $10,000, your total cost for owning a piece of America's 500 biggest companies for an entire year is just $3. That is unbelievably efficient. Now, let's bring in our next contender, the legend itself, SPY. This is the granddaddy of them all. I mean, this was the very first exchange-traded fund, or ETF, ever listed in the United States way, way back in 1993. It's still one of the most famous tickers on all of Wall Street. Now, here's the catch. While SPY holds the exact same stocks as VOO and IVV, it comes with a higher price tag. Its expense ratio is 0.09%. So for every $10,000 you invest, you're paying $9 a year. That's literally triple the fees for the exact same investment. So why on earth would anyone pay 3 times more? Well, the answer comes down to one word: liquidity. In simple terms, liquidity just means you can buy or sell a huge amount of something really, really fast without messing up its price. And because SPY is so massive, big institutions can trade billions of dollars in and out of it in the blink of an eye. For those high-volume traders who need that split-second execution, SPY is still king. But wait, the story doesn't end there. State Street, the company that created SPY, saw that people wanted a cheaper option. So they came out with SPYM, a fund that was literally built to compete on one thing and one thing only, being the absolute lowest cost option you can find. Let's bring back our cost chart for a second. Look at that. SPYM slides in with an expense ratio of just 0.02%. Yep, that's right. It's even cheaper than VOO and IVV. So on that same $10,000 investment, you're only paying $2 a year. For long-term investors who want to squeeze every single penny out of their returns, SPYM is the new champion. All right, it's time for our final contender, and this one plays by a totally different set of rules. This is RSP, the Invesco S&P 500 Equal Weight ETF, and it's so unique because it completely ignores how big a company is and takes a pretty radical approach to building a portfolio. Okay, so first, let's just remember what a normal S&P 500 fund looks like, right? It's dominated by a few of those tech giants. Huge companies like Apple and Nvidia take up these massive slices of the pie, while hundreds of other great companies in the index are just these teeny tiny little slivers. Now RSP throws that whole idea out the window. Instead, every single one of the 500 companies gets an equal, identical slice of the portfolio. This means a smaller but still awesome company like Lululemon has the exact same impact on your returns as a mega giant like Microsoft. It's a totally different philosophy. But as you can imagine, this unique strategy comes with some major trade-offs. The big plus is that your portfolio isn't so heavily tied to the performance of just a few big tech stocks. But the downsides, they're pretty significant. You're looking at a much higher fee of 0.20%. That's 10 times more than SPYM. And its returns over the last decade have actually been lower than the regular index. Okay, we've seen all the contenders, we've looked at their costs, their structures, their different strategies. So now it's time to head to the winner's circle and finally figure out the best choice based on what kind of investor you are. This right here, this is your ultimate cheat sheet. If you're an active trader moving big money around and you need that maximum liquidity to get in and out instantly, then SPY is your champion, even with the higher fee. If you're a diversifier who's worried that big tech has gotten a little too big, RSPE offers that unique equal weight solution. But for most of us, for the long-term buy and hold savers, the clear winners are SPYM, VOO, and IVV. They give you the S&P 500 at the lowest possible cost, period. So there you have it. You see, the choice between these funds isn't really about which one is the best overall. It's about which one is best for you and your specific goals. You've seen the data, you understand the strategies, so the only question left is which one of these champions is right for your portfolio.